The market is currently staring down NASDAQ SLS hovering around the mid-teens, consolidating fiercely near its 52-week highs as retail investors flood online trading apps and Reddit forums trying to figure out if this is the ultimate biotech moonshot or another late-stage clinical heartbreak. While standard financial media anchors drone on about quarterly net losses and routine cash burn metrics, they are missing the entire structural reality of what is happening behind closed laboratory doors. We are looking at a masterclass in clinical stage mispricing, a severe disconnect between the mechanistic potential of targeting one of oncology's most elusive biological gatekeepers and the short-termist volatility that shakes out impatient retail accounts every single day. The core bottleneck in oncology has never been a lack of aggressive capital. It is the fundamental challenge of engineering immune responses against intracellular proteins that standard monoclonal antibodies cannot physically touch. While legacy players rely on blunt force chemotherapy that carpet bombs healthy tissue alongside malignant cells, a quiet technological revolution is taking shape around precision peptide immunotherapies and selective kinase inhibition. This is where institutional heavyweights quietly accumulate positions during quiet market pullbacks, letting retail panic supply them with cheap float before the definitive clinical catalysts hit the tape. To understand the ferocious price action and relentless volume spikes in SELLAS Life Sciences, you have to look past the ticker symbol and examine the intricate mechanics of institutional positioning and short interest dynamics. With short interest historically hovering near elevated levels of the available float, the stock behaves like a coiled spring, reacting violently to every tick of macroeconomic sentiment, treasury yield fluctuation, and sector-wide ETF rotation. Institutional accumulation by heavyweights like Vanguard and specialized healthcare funds hasn't happened by accident. It is a calculated bet on binary clinical milestones. When broader market jitters or Middle East-driven oil shocks trigger sudden risk-off liquidations across the Russell and NASDAQ, retail traders panic sell at the lows, terrified of dilution or clinical trial delays. Meanwhile, smart money algorithms scoop up those shaken-out shares, positioning themselves ahead of the ultimate structural squeeze. Before we break down the operational pipelines and the history of how this asset evolved from academic obscurity into a clinical powerhouse, let's check in with you. Are you holding a core position in SLS through this volatility, or are you sitting on the sidelines waiting for the final Phase 3 data readout before diving in? To truly grasp why SELLAS commands such intense speculative and institutional attention, you have to strip away the outdated framing of old-school pharmaceuticals and examine its core pipeline assets, galinpepimut-S, GPS, and SLS-009, tambiciclib. Historically, small-cap biotech was viewed as a binary coin flip funded by endless dilutive offerings and plagued by scientific dead ends. SELLAS flipped this script by licensing breakthrough science directly from premier institutions like Memorial Sloan Kettering Cancer Center. GPS is engineered to target the Wilms tumor 1 antigen, which the National Cancer Institute has ranked as a top priority target in cancer immunotherapy because it is wildly overexpressed in an array of deadly hematological malignancies and solid tumors. Because WT1 is intracellular and historically considered undruggable by small molecules or inaccessible to standard antibodies, GPS acts as a synthetic heteroclitic epitope immunotherapy, training the patient's own immune system to hunt down and annihilate cancer cells expressing the antigen. Simultaneously, the company's second major asset, SLS-009, a highly selective next-generation CDK9 inhibitor licensed from GenFleet Therapeutics, is demonstrating profound efficacy in hard-to-treat blood cancers and advanced solid tumors like pancreatic ductal adenocarcinoma, PDAC, specifically cutting through resistance mechanisms that render standard RAS inhibitors useless. Looking ahead, the multi-year growth catalysts for SELLAS are defined by a series of monumental, high-stakes clinical milestones that could entirely redefine standards of care in oncology. The the primary immediate focus of the market is squarely locked on the final survival event threshold of the pivotal Phase 3 REGAL trial evaluating GPS in acute myeloid leukemia patients, alongside robust enrollment and upcoming top-line data readouts for SLS-009. With a strengthened balance sheet boasting over $130 million in cash reserves following strategic financing moves, the company has the financial runway necessary to navigate regulatory pathways without buckling under immediate capital pressures. While supply chain execution, clinical trial timelines, and the inherent regulatory hurdles of FDA approvals remain standard sector risks, the technological gatekeeper positioning SELLAS holds in WT1 targeting and selective CDK9 inhibition makes it a prime candidate for strategic partnership or M&A chatter among big pharma giants hungry for late-stage oncology blockbusters. In the end, looking past short-term price noise and understanding the deep biological mechanics at play is what separates generational investing gains from ordinary retail noise.